Mortgage rates nearing 7%. What does this mean for the millennial homebuyer? Coming up here in the Jog. Hi folks, Alex Klingelhoeffer here with Exencial Wealth Advisors. It is 8:25 here in the middle part of the country on Monday. It is October 10th, 2022. Here's your morning jog around the economic headlines of the world. I want to start off with a couple of policy notes. First and foremost, the Biden administration has blocked some chips from going over to China. These are AI chips, sort of the super high end of the spectrum. That's causing semiconductor stocks around the world to take quite a bit of a hit on a go-forward basis. If you're looking at where semiconductor manufacturing is going, it's coming back to the U.S. It's really one of the biggest industries that is reshoring or onshoring, quite frankly, for the first time for many of these companies, bringing supply lines back to the U.S. where that technology is being deployed and used. It's kind of like what cars did over the last 10, 15 years, right? Let's build the chips in the markets where they are being used. China, not a beneficiary here. Bank of England also updating some policy here. They're going to double their buyback plans for gilts. That's bonds for pound sterling, more than 20 years in duration. Look, it's just about creating liquidity for pension funds, making sure they can meet their liabilities in the short term, right? I give you a bond, you give me pounds, I can pay my liabilities, even when those sort of bonds are being marked down, right? In the short term, don't want to have a market where there are no buyers for those instruments. Those pension funds do need the liquidity, and they're the ones buying those 20 and 30-year notes because they're the ones that have 20 and 30-year liabilities. On a go-forward basis, this looks relatively contained, does not look like it's going to have much contagion for the overall financial system. Last but not least, let's talk about what we talked about off the top. Interest rates nearing 7%, like 6.6%. Another survey had 7% for new home buyers. What does this mean? This huge volatility in interest rates. Well, first and foremost, what it does is it makes housing more expensive when you look at financing a property. That's kind of the obvious point. Second point is that it locks in folks who would have otherwise moved. If you got a mortgage at 2.5% on 30-year money, you're very sort of timid or not incentivized to give that up and go borrow at 6 and 7% notes on a new purchase. What does this mean for the broader economy? Well, it means less housing switching. It means what we call friction in the housing market. When people stay put for longer, they also tend to improve those houses more than just trading up. So what it likely means is we see a whole lot of new builds for millennials that need to start houses no matter what the cost is in terms of interest rates, right? Lots of starter homes, not so much of the new big McMansions, right? Because the folks that already have comfortable homes don't want to go and buy those McMansions at 6 and 7%. So lots of starter homes and lots of improving existing homes, which you can finance through things like home equity lines of credit, which yes, are higher than 30-year notes, but trust me, having a 2.5% 30-year note plus like a 9% HELOC is way better than refinancing the whole thing at 7% or buying a new home at that rate. So that is what it looks like. Those are the incentives that are available in the market. Those are the trends that we'll be watching going forward, and that will certainly inform many of our investment decisions. If you want some additional info throughout the week, feel free to find me on the internet. I am out there. Until then, you and your family, hope you have a really good rest of your Monday. I am